Hello, everyone. Welcome to Georgetown University in Qatar. Before I start, let me ask you to turn off your cell phones or put them in vibrate. Thank you. We are very excited to have with us today Dr. Khalid Al Khater, Director of Research and Monetary Policy at Qatar Central Bank, to give us a very interesting talk on the macroeconomic framework of Qatar. I want to give some background information on this lecture. In Georgetown, our students are asked to take a lot of economics courses. One of them is international finance, where we talk about exchange rates, how fiscal policy affects economic outcomes. We talk about currency unions, we talk about financial crisis. The other thing we do, we try to augment and complement the experience of the students beyond what is in the textbook. And we try to bring our own research, our own expertise into the classroom. We engage them in research projects. We encourage them to get internships. They go on learning trips. But we also rely on speakers with a lot of expertise to come here and present and interact with the students. And for the last 5 years, we've been very blessed to have Dr. Khalid come every year and give a very exciting talk. In addition to having the students benefit from this, because the talk is of so much interest to people in the field of economics and business and people living in Qatar, we open it up to the general public. And we are very happy to see so many of you come today. So without further ado, I would like to welcome Dr. Khalid Al Khater. You have 45 minutes to 50 minutes to present.
No problem.
And we really look forward to hearing what you have to say. Thank you.
Thank you very much. I'd like to thank Georgetown, particularly Dr. Alexis Antoniadis, for hosting me today to speak before this distinguished gathering. And second, I'd like to emphasize that what I'm going to say here today represent my own opinion and my view and does not represent Qatar Central Bank. And I am an economist from Qatar, as you can see, obviously. And I am specializing in monetary policy and political economy. Our talk here today is about the macroeconomics management framework in Qatar and the GCC state. So what do we mean by macroeconomics management framework? It can be thought of as a set of economic policy that can be used as an instrument to manage the macroeconomy, such as fiscal policy, monetary policy, exchange rate policy, and trade policy. Our focus here today will be on stabilization policy, namely fiscal, monetary, and exchange rate policy. First, start with a historical review of the development of the Qatari economy. We have came across different stages in our modern history of economic development since the first oil export shipment in 1949, followed by the first government budget and first bank to be established in the country. Both were in 1950 as well, and the first GDP statistical record also, which was estimated to be about 760 million US dollar, was also in 1950. The first national bank was in 1965. The economy was basically a single resource sector-based economy that was dominated by foreign trade and operated by foreign companies. There was no national currency and no monetary authority, and the financial sector was underdeveloped and not integrated with the outside world, and there was no capital market. Then shortly after we gained independence in 1971, and particularly after the first oil shock in 1973, the economy started to embark rapidly on earlier stages of development, with substantial increase in oil revenue that was reflected in higher GDP growth and development of infrastructure and state institution. We had also the first sovereign monetary authority with national currency that was de facto pegged to the US dollar in order to provide a nominal anchor to provide monetary policy credibility with low inflation, to import monetary policy credibility with low inflation from the United States on one hand, and to stabilize government oil revenue on the other hand, which was channeled into the economy through government fiscal expenditure. Indeed, this simple uni-instrument, uni-tool macro policy framework worked well for the economy at the time. Then for 2 decades after that, the economy basically stabilized on a steady low growth path, moderate growth, quiet moderate growth in GDP and trade sector, and not much development in money and credit and financial market. This situation continued until the beginning of the previous decade when we started to witness the emergence of 2 fundamental changes, one internal and the other is external. Internally, the economy started to experience unprecedented resource boom at the backdrop of higher oil prices and LNG exports, which led into a tremendous economic transformation and strong growth in all sectors of the economy, GDP, trade, import, export, money market credit, deposit, banking assets as a ratio of GDP. It's even surpassed GDP. And by the end of the decade, the Qatari economy was transformed into a vibrant, more developed, growing, emerging market economy. And now we have money market, capital market, and financial market, and they are more developed, more sophisticated, and integrated with the outside world. Also, the indicators of the Qatari economy increased by manifold from their respective level at the earlier stages of development. For instance, GDP increased by more than 270 from its level in 1970 by the year 2013. Likewise, export, import, money supply, domestic credit more than 300 fold, total deposits, banking assets, government expenditure more than 32 times and more than 24 times. Likewise with revenue. This is internally. Externally, also, by the beginning of the previous decade, signs of a structural shift in global economic power started to prevail, commencing the emergence of a multipolar global economic system. And before that, we know that the US share in world output was on a general secular decline ever since it peaked in 1945 after Second World War. And indeed, researchers now show that what is called the world center of gravity or the world center of economic activity is actually moving from the West eastward. And according to Professor of Economics, Professor Danny Kwa of Economics, from the London School of Economics, the world economic center of gravity actually have moved from its location in the mid-Atlantic by the year 1980, reaching Turkey in 2008 on its way to somewhere between India and China by the year 2050. Now, in my opinion, this study is a bit conservative. I think it will reach there even before 2050. What does this mean for us here in the GCC state? It means also that the center of gravity of demand, of world demand on commodity, including oil, is also moving from the west eastward. And this weakened the historical relation between the oil cycle and the US economic cycle, making the former one more correlated with the rising East Asian economy. And therefore, also, we were consequently the economic cycle between us and between the United States were weakened or delinked. Before 2000, the US economy was leading the oil market. However, after the year 2000, China, India, and other East Asian economy have been leading the oil market. Therefore, the oil market and the US economy were desynchronized. While the oil market was booming over the previous decade, the US economy was slowing down, and therefore also consequently we were desynchronized with the United States while we depend on oil and peg our currencies to the US dollar. So our economy expand with higher oil prices, and our policy interest rate also decline or decrease with a slowdown in the US and with policy rate cut in the United States. Why? This is because monetary policy in the United States, like any monetary policy in the world, in most countries, is directed towards serving domestic objectives. So when there is a slowdown in the economy, the central bank, the Federal Reserve in the United States, cut interest rate in order to stimulate the economy. And because we peg our currency to the US dollar, so we have to follow through and cut our policy rate as well, although our economy were booming. Here I'd like to show some indicators and evidence of the diverging cycle between us and between the United States. As you can see here, East Asian economy becoming our dominant export trading partner, and this makes us subject to more shocks originating, demand shock originating in other than the United States. More evidence from our own research finding. If you see here in this graph, you see there is a clear divergence between development in oil market and GDP development in the United States. Oil prices start to increase from the year 2002, while there is a slowdown in the US economy started by the year 2004. So there is a clear divergence here. And this is also reflected in lower interest rate, lower policy and money market rate in the United States in order to stimulate the economy. And this is means that there is a divergence between US monetary policy and development in oil market. While this is the case, here, if you look here compared with Qatar, here there is development in Qatar GDP is closely shadowing development in oil market. So all of this here reflected in a clear divergence in development and real GDP growth between the two countries. While over the past decade, while GDP in Qatar was booming with vigorous growth of averaged about 13% real GDP growth annually, there was a slowdown to moderate growth in the case of the United States with 1.57 annual growth. Finally, all of these boils down to a divergence in very important variable between the two countries, and that is the inflation rate between the two countries. If you see here, inflation in Qatar is volatile and shooting up, while it was moderate to low in the case of the United States. And this is when the US dollar peg start to be destabilizing in the GCC country. So repercussion for the GCC state under the current policy framework and the diverging cycle. When you peg your currency to another country's currency, it's an equivalent of establishing monetary union or monetary area with that country. And for that union to be stable, to be successful, you better have both economy has to be subject to symmetric shock, or the economic cycle has to be synchronized, has to move in harmony in the two countries. Otherwise, you can have policy conflict between the two countries. And when you have a policy conflict and attempting to maintain identical monetary policy at a time of conflict can be very costly and can be destabilizing to the national economy. This is because economic policy required at time of boom differ from those required or suitable for at a time of slowdown or recession. During a boom, what you need is a contractionary monetary policy in order to stabilize the economy, to prevent the economy from overheating, and to anchor expectation and to combat inflationary pressure. While this is the case, however, what happened over the previous boom cycle and inflationary episode in the GCC state, that was all central bank in the GCC were instead adopting highly expansionary monetary policy, mandatory imported through the US dollar peg, the consequences of which were all mess, like a speeding vehicle without a brake. Overheating economy, abundant structural liquidity surplus building up in the banking system, very low money market rate, excessive money and credit growth, high inflation in some country, bubble bursting in the stock market as we saw, and real estate as we saw in most GCC states in 2006 and 2008. And last but not least, also speculative attacks on national currency, as we saw in most GCC countries in the year 2007 prior to the eruption of the financial crisis. I can think of the economy as a car, and you have the accelerator, the petrol, and this is like fiscal policy. So you step on it more, the car will go fast and go faster. So what do you need to stabilize the car? You need a brake. Otherwise, you won't go far. We might find you just in the first roundabout here outside the education city. This brake is monetary policy. So our experience here in Qatar, first I'd like to do just a quick review of the stylized fact of the Qatari economy. We have a small population because we are small in number. Also, we have to import labor from overseas, and by importing labor, you have a flexible labor supply. That means when the economy boom, you import more labor, and when the economy contract, you shrink your labor for size. So this is good and bad. Good economically because it acts as a shock absorber at a time of recession and time of slowdown, but it also has social and demographic consequences. The economy is small, which means that it cannot influence international prices, and you have to take them as given. It has a narrow and undiversified production base, which limit real investment channel and subject the economy to supply bottleneck. It is also highly dependent on hydrocarbon sector, which constituted about 55% of GDP, 79% of export, and 57% of government revenue over the past 10 years. And this subjected the economy to volatility in global energy market. If you have a small and undiversified economy and highly specialized in natural resources, then you better have that economy open. So in order to export your specialization and import whatever you need from overseas. And indeed, the Qatari economy, likewise, other GCC economy is highly open, with foreign trade constituting about 80% of GDP over the past 5 years. So we export oil and gas, and we almost import everything else. And this subject the economy to imported inflation. Also, fiscal expenditure is the main mechanism of channeling resource revenue into the economy, and therefore it is the main engine of growth. Therefore, you have a pro-cyclical fiscal policy stance, pro-cyclical monetary expansion, counter-cyclical debt management, a pro-cyclical population growth. The population in Qatar, for instance, this is a very clear phenomenon here in Qatar and in the GCC. In Qatar, the population more than doubled in a matter of 4 years, from 800,000 in 2005 to 1.6 million in 2009. Can anyone tell me why is this from the student? I mean, this cannot be due to standard or natural fertility rate, right? It has to do with the second stylized fact. So you import the economic activity booming, you need labor from overseas, you import labor, that's increase in population. So, and this create demand pressure and supply bottleneck and feed into inflationary pressure. Hence, we have a pro-oil cycle aggregate demand, pro-oil cycle GDP growth, and therefore monetary policy strategy of targeting the exchange rate through pegging to the US dollar was feasible strategic choice in order to stabilize government oil revenue and to import monetary policy credibility with low and stable inflation from the United States. And indeed, this objective had been accomplished until the beginning of the previous decade, and this framework worked well for the economy then. However, targeting exchange rate subject the economy to exchange rate pass-through through weaker and volatile U.S. dollar, and through also importing the easy U.S. monetary policy stance and the low policy rate, and also through importing the low money market rate from the United States to our money market. Here I'd like just to show the inflationary process as we have experienced it over the previous inflationary episode here in Qatar. First, we start with what economists called a shock. This shock was increase in oil revenue, which led into increase in government expenditure, whether current or investment expenditure on in development, infrastructure, or diversification, or social services. This feed into demand pressure on goods and services, both type of goods and services, tradable goods and non-tradable good. Tradable good that can be exported and imported from overseas, and the non-tradable good is those that cannot be imported or exported from overseas, such as housing unit, and some kind of services. So, increase in government expenditure, increased demand pressure on both type of goods and services. Also, increase in government expenditure create immediate monetary impact, monetary expansion, because you don't spend with foreign currency here. You have to exchange those US dollar from oil revenue for local currency and through the central bank, and that create monetary expansion, and the monetary expansion feed into further demand pressure on tradable and non-tradable goods and services. Also, increase in government expenditure lead to increase in population growth through enlarging the labor force. Labor force lead to increase in population, and increase in population create further demand pressure again on goods and services, because these people need to live, they need accommodation, they need to send their kids to school, and this create demand pressure on both type of goods, consumption good and non-tradable good. Also, there is another channel, inflationary expectation. High expansionary fiscal policy and monetary expansion feed into inflation expectation, because market participant, producer, and distributor know that this will lead to higher prices in the future, so they act ahead of time and they start increasing the prices in order to make a profit. And by doing so, this feed into higher prices, whether the anticipation or their prediction is true or not. Also, there are another channel of, and this feed and feedback effect, okay? So inflationary expectation lead to higher prices, and higher prices lead to further inflationary expectation. And there is also capital inflow from overseas due to many reasons. One of them is hot money speculating in the stock market and FDI investment, and this is welcomed. And there is also speculative attack on our exchange rate, as we mentioned earlier, and there is also some national capital coming back due to geopolitical reason after the September attack in the United States. All of these feed into further monetary expansion, and this feed into further demand pressure. Also, there is the imported U.S. monetary policy stance through the U.S. dollar peg, and this means lower interest rate on the U.S. dollar, which translate into lower interest rate on the Qatari riyal, and this put lower pressure or feed into monetary growth and credit growth. Also, there is the exchange rate pass-through. Weaker US dollar means weaker Qatari riyal against our non-US trading partners. So this feed into imported inflation, into tradable good. Also, there is the imported inflation due to higher prices in our trading partner, which feed into tradable good, and there is nothing you can do about this. We are not done yet. There is what's called the second round effect, or the interaction between all these variables. So, for instance, rent inflation spread through the economy and feed into higher inflation or higher prices of tradable good. Likewise, tradable good feed into non-tradable good through intermediately imported good from overseas that's used in the production of final good produced here locally. So now the picture is almost complete. All of this feed into general CPI inflation. If there is time, I'd like just to give one example of asset price bubble. Let's assume that you had a dream that there will be the prices of real estate and housing will increase tomorrow, and then you can be a millionaire. So you rush, you wake up in the morning, but you don't have enough money. So you go to the bank to borrow money from the bank. You have a house, you make that house as a collateral, and then you rush and you buy a piece of land or a house. If this is done by many people, this will automatically lead to higher prices. So expectation led to higher prices, whether your dream was true or false. Increasing the price will also attract more people to buy because they want to make the same thing. They want to make capital gain. So it's like this. Expectation lead to higher prices, and higher prices lead to expectation, and so on and so forth. And this process continues until it's end in a sad way, a bubble bursting. And what feeds this? Usually excessive credit expansion. Almost in all financial crises were usually preceded by two factors. Assets price inflation and excessive credit growth. So be careful. What did we do about all of this mess from our monetary policy crisis approach experience? Here, this is the well-known impossible trinity triangle due to the Nobel Prize winner economist Robert Mundell, which basically shows that a country cannot have more than two of the three policy choices here. So if you want to have capital mobility with fixed exchange rate, then you automatically lose monetary policy independence. This is the situation prior to the crisis, and this is the location of the Qatari Riyal before the crisis. However, this situation changed after the crisis. One pillar of this impossible trinity triangle was broken, and due to freeze in international capital mobility, and for the first time ever, you could have independent monetary policy under fixed exchange rate. So we realized this at earlier stages of the crisis, and we decided to separate ourselves from the easy U.S. monetary policy stance and isolate ourselves from the U.S. policy rate, and we started this in 2007, where we abstained from lowering our lending rate, and we kept it constant at 5.5%. And then also by October 2008, after the eruption of the financial crisis, we also abstained from lowering our policy deposit rate, and we kept it at 2%, while the US Fed continued to cut its policy rate with other major central banks until it reached the zero lower bound, and after that, as we know, start to use quantitative easing. Here, this is prior to the crisis. As you can see, our policy rate was closely shadowing the US Fed policy rate until this period, where the US policy rate now dived and our policy rate continued to be higher than the US policy rate. We realized for the first time ever that we could conduct an independent monetary policy under fixed exchange rate, and we wanted to seize that historical moment to temper the high inflation down at the time, so to ride the next economic cycle with the lowest inflation rate possible. And so we did look at our inflation rate. It came down from the highest in the GCC state at 15% in 2008 to the lowest at almost minus 5% by the end of the year 2009. So tightening monetary policy stance and increasing real interest rate contributed into drying up structural liquidity surplus in our banking system prior to the crisis, and also this lifted up our money market rate, which was collapsing near the zero lower bound, and stabilized it around our policy rate. And also this slowed down the excessive money and credit growth at the time, and all these factors contributed into lowering inflation. Here, in this graph, this just shows the structural liquidity surplus building up prior to the crisis, and this was due to speculative attack on exchange rate. And here, as you can see, it's stabilizing at an acceptable level. This is not genuine capital inflow. And here in this figure down here, as you can see, Qatar interbank overnight rate was very low, near the zero lower bound, much lower than international rate. And after the crisis, how the situation is switched, now our money market rate is stabilizing nicely and smoothly around our policy rate, while international money market rate are collapsing near the zero lower bound here. This shows that our money market is independent from international markets, and that QCB, Qatar Central Bank, is indeed formulating and conducting an independent monetary policy from the US Fed. This is the past. What about the future? The present up to the year 2022. Here, the government in Qatar is committed to a long-term, multi-objective fiscal expansionary program related to World Cup 2022 and related also to development and diversification target within the Qatar Vision 2030 and others as well. So in this case, monetary fiscal policy tend to be highly expansionary and inflexible. Likewise, in other GCC states, if fiscal policies are expansionary due to development and diversification program or due to rising economic or socio-political or geopolitical challenges ahead, then the fiscal policy, the only available policy tool, policy instrument within the current policy framework, will tend to lose flexibility, at least in the downward direction. Therefore, there is a need for other economic policy to stabilize the economy, such as monetary and exchange rate policy. In Qatar here, for instance, with a current inflation rate of 2.7 and core inflation rate of 1.7 and rent inflation rate of 5.8, there could be a potential for a buildup of inflationary pressure over the coming 10 years. It could be gradual and creeping, but it could lift the cost of living by the end of the period. Here, just I would like to share with you the development of the main component of inflation in the pre- and post-crisis period. As we see here in the pre-crisis period, rent, this red line, is the dominant factor behind inflation. And here, this is in the run-up period to the financial crisis. There is a divergence. Core inflation is rising while rent inflation is declining. This is since investor or speculators in the United States were started to run away from real estate and housing market and start to invest in commodity in Wall Street, and this was translated or reflected in higher imported inflation here in Qatar. And rent is declining here partly due to saturation in the market at that time, and then here it's a full-fledged financial crisis with decline in all components of inflation and labor exiting also, although limited, from the market. Here, over this period, now stable trend in all inflation component, but where are we heading? There are some indicators which can help us predict the future path of inflation. In this figure, you see we have money supply, private credit, and domestic or total credit, and non-hydrocarbon GDP. As you can see, all of these factors, money supply, domestic credit, and private credit, are growing at a faster rate than non-hydrocarbon GDP, and indeed also more than hydrocarbon GDP. This means that aggregate demand is growing at a faster rate than aggregate supply, and this usually tends to generate overheating in the economy and generate demand, generate inflationary pressure. So all indicators together, we have highly expansionary fiscal policy, we have accommodative monetary policy, that means easy monetary policy, and we have relatively high money and credit growth. International and commodity prices are on the rise in the long run. You have a population growth, which tend to generate pressure on rent inflation. The US dollar exchange rate is appreciating in the short to medium run, but will depreciate in the longer term. So all of these factors says that inflation will be trending up in the future. Now, what about post-22 and the shale fuel production in the United States? This is another challenging issue that also reinforces the need for upgrading the current macroeconomics management framework in order to diversify the economy besides stabilizing the economy. However, the shale fuel production in the United States and elsewhere may not be as bad as many may think, especially if it's force and expedites diversification by necessity, so leading to more efficient utilization of the resources and their revenue, and hence less reliance on hydrocarbon sector and slower rate of extraction, which preserve future generation share in this vital and non-renewable resources. Policy implication for the GCC state, the shale fuel production in the United States may not present a serious challenge over the short to medium term. However, a decade after that, it may put us on the downward side of the economic cycle. However, this issue is still debatable, but we can think, it doesn't hurt to think of two scenarios in this case under the assumption that the United States will be self-sufficient in fuel production. We can think, first one is that there is excess demand on energy, excess global demand in energy, which lead to higher prices, or at least prices will not go down, and then we will be synchronized with the United States and we will have no problem. The other possibility is that there is excess global supply of energy, which lead to lower prices and maybe lower export in our case as well, and this will lead to desynchronization of the economic cycle between the GCC state and the United States. If we desynchronize with the United States, then we should diversify the economy now more than ever before, since it's more difficult to diversify a slowing down economy. However, economic diversification entails policy diversification. You may not be able to diversify the economy with one policy instrument, so there is a need for more policy instrument, particularly exchange rate. So how can we transform the exchange rate from a constraint on economic policy and a constraint on central banks into an instrument of economic policy? This can be also achieved or accomplished through the Gulf Central Bank. So instead of being targeted the exchange rate itself, which strip the exchange rate and also with the monetary policy from your policy toolkit, exchange rate itself can be used as policy instrument to combat inflationary pressure, to anchor expectation, and therefore help maintain low and stable inflation and contribute into financial stability. It also can allow higher ceiling for government expenditure with less worry about inflationary buildup. So development and diversification program can proceed at planned pace with less costs in terms of higher inflation. Also, it can improve competitiveness through enhancing the productivity of existing and newly established firm, therefore contributing to an urgently needed diversification process. Last but not least, also, a flexible enough exchange rate can free monetary policy to assume its role in macroeconomic management. More flexible and independent monetary policy is needed so it can be used effectively and proactively in addressing domestic economic need, particularly stabilize the economy at a time of expansionary cycle and stimulate growth at a in the contractionary cycle. And this is consistent with what His Highness the Emir pointed out too in his Shura Council speech regarding the important role of monetary policy in macroeconomic management, particularly in containing inflation. To achieve this long-run objective, you need more than a simple uni-instrument, uni-tool macro policy framework. This policy framework, which was adopted more than 4 decades ago, was suitable for the earlier stages of development. However, the world has changed. It was not even suitable during the past boom cycle and the associated inflationary episode. And the GCC experience is an evidence in this case. What you need here, the economy also now have gone through tremendous transformation and development, and now we have money markets, financial markets, capital markets, and they are more developed, more sophisticated, more integrated with the outside world. Also, the world around us has gone through structural change, which led into the emergence of multipolar global economic system and into a divergence of the economic cycle between us and between the United States. Also, there are potential challenges ahead with the shale fuel production and the mounting American public debt. So all of these factors ask or suggest that we activate other economic policy that has not been activated or has not been used yet to construct the appropriate policy mix of the 3 policy, fiscal policy, monetary policy, exchange rate policy, so that enable us to face these future challenges and to steer the economy in the desired direction toward achieving stability and sustainable growth and development. Just this is to compare. This is the current, how I visualize the current policy framework compared with the long-term stabilization policy framework, which consists of exchange rate, monetary policy, and fiscal policy. If there is enough time, I'd like to go over to talk about diversification. Economic diversification also entail investing in diversifying the production structure away from hydrocarbon and from associated industry, and also investing in diversifying the revenue away from hydrocarbon rent. Diversifying the economy is a long-term, diversifying the production structure is a long-term challenging issue, which entail or necessitate investing in the development of human capital stock accumulation and industrialization, market reform, and infrastructure development as well. The most challenging task is diversifying the economy, and the most important and challenging element in diversifying the economy is the development of human capital stock accumulation. Development alone is not enough. In many third world countries, there are no shortages of university and college graduates. However, the stock of human capital does not accumulate to reach the critical mass or the critical level where it can put the economy on self-sustainable high growth path. Why? Deflection occurs for many reasons, among which the large and relatively unproductive public sector and the weak role of a private sector in general in development process, the inconvenience of work environment, and lack of market discipline, the interest group competition, loyalties, corruption, rent-seeking, weak governance, low institutional equality, and so on and so forth. The GCC states also need to invest in increasing the national population put incentive on children in order to expand the base from within which you can develop and accumulate a human capital stock to begin with. Modern growth theory now emphasizes the importance of population growth in economic growth. And aging population is now a serious issue in many advanced countries, in Japan, in the Euro area, in the United States, and even in China. For instance, in the Euro area now, mounting public debt soon will be difficult to manage due to rising fiscal expenditure on healthcare and pension fund and social security. And if this kind of debt is included in the debt calculation, the debt as a ratio, the debt of the Euro area as a ratio to GDP can rise to reach 330. China recently, as you may know, eliminated the one-child policy, and partly due to aging population. However, here in the GCC state, we face a different issue. We face the demographic challenge and melting national population. So besides investing also in increasing the national population, also you need to invest in improving the quality of human capital through investing in a proper education and proper training all the way through from primary to the highest education. Also invest in science and research, invest in improving the quality of healthcare and social services, improve public management scheme and governance at public sector, and improve institutional quality. Qualification, skill, specialization, and competency need to better match requirement for management at public sector and public institution. This is to create the incentive among the younger generation to invest in educating themselves. Beside also to attract qualification, skill, and capacity building among the higher generation or older generation. The GCC state also need to diversify away from associated industry. So far, most of the diversification is still within the associated industry, hydrocarbon industry, so you need to diversify away from this. And they need to embark on industrialization for many good reasons. One of them is that the rent distribution scheme adopted in the GCC states since oil discovery cannot be sustained for long in the future due to rising economic challenges, demographic and socio-political challenges ahead. Hence, there is a need for other sources of income to reduce social pressure and to support sustainability. Also, one good reason for industrialization is that it is create new jobs and thus help absorb the growing unemployment. Also, it can create import substitution industry, hence reduce import bill. And if successful, it can create also export-led manufacturing, which can also create another source of income. It can also contribute into technological advancement. To do so successfully, the GCC state need to benefit from the economy of scale and expand the market. This is another good reason for monetary and economic union among the GCC state. Due to market size limitation, there is a need for factor and good market integration among the GCC state to make industrialization, especially heavy one, feasible. Also, diversification also implies parallel diversification of private sector activity. So far, private sector activity is still concentrated in 3 areas: trade, imports, services, and construction. So reform is needed to promote competitiveness and fair and equal opportunity, and to address market concentration and curb monopolistic practices. So what you need first is you need to dismantle monopolistic structure, if any, in the economy, and issue relevant antitrust law and enforce them to combat monopolistic practice and to regulate natural monopoly. Also, there is a need to review and regulate the agency system. The agency system started with the beginning of development process in the region, but it tends to grow vertically over time. That means it doesn't expand across wider segment of the population, rather with the expansion of the market and with the emergence of a new product and services, it rather tend to be concentrated within the same segment of the society, and this can be harmful economically and socially as well. Therefore, it should be regulated in such a way that it can promote competitiveness, fair and equal opportunity, and enhance market efficiency and consumer rights. This should also contribute into combating inflation and price distortion, and improve product and service equality, and promote more equal distribution of wealth in the society. The government can lead the private sector diversification attempt through planning, expertise, and funding, and through also protection from unfair foreign competition, particularly for infant industry, and also equally from unfair competition from state-owned enterprise. Also, it can help through state-led manufacturing and industrialization program. Also, you need to invest in revenue away from hydrocarbon revenue through investing cross-currency and cross-country, and also accumulate real and financial assets. And thank you very much.